Today on InvestTalk, we look at the companies with the most at stake in the election outcome. We then look at the geopolitical events impacting markets today. I also take calls about Nvidia, Carvana, CVS, and more. And at the end, I look at if a recession automatically means large market losses.
This is InvestTalk, independent thinking, shared success.
Now let's pivot to my main focus point today, and that's about the election coming up. We are just, a little over a month away from the election, and there are companies that will benefit and will be hurt by the outcome of the election, whether that is another Trump administration or a Kamala Harris administration. And understanding the impact is going to be vital for your portfolio. But we'll highlight a few companies here that could be influenced by the political outcomes, such as what happens with regulators, renewable energy policy, foreign policy, trade policy, etc. Now, the number one company that I think that holds a lot of weight in this election is a company that's done well recently, and that is Nvidia. And we know that they are a driving force behind the AI industry, the AI trade, etc. And it's well positioned for, I think, the longer term. However, it's trading at premium valuations. You have a forward PE of 42, forward price of sales at 23 plus, and both of those are significantly above the sector averages. So they're heavily reliant on continued growth in the business. If growth slows by any reasonable amount, certainly those multiples are going to come down. That's just how this works. Okay, so that growth could be hurt for many reasons, including the election outcome, like I said. And U.S. and China trade tensions will certainly be a big factor here. If tensions heat up, that could unduly influence the intellectual property that Nvidia has and their ability to sell it worldwide. And, China could be cut off from them potentially. Okay. And that would hurt their leadership position worldwide in the semiconductor space. They also have strategic partnership with Microsoft, and they're aiming to integrate Nvidia's AI technology across Azure, and that's going to open up new growth avenues for both. And ultimately, if there's some regulatory change that forces Microsoft to pull back from that from certain markets, that could hurt both companies. Okay. Then there's Snap. They bet big by donating to the Democratic administration. So I think that's something that will this administration will certainly benefit them. Now they are trading relatively cheaply, and it's down a lot. So that could certainly be one that benefits from a Democrat win. And then on the flip side, Tesla would probably benefit from a Republican win. Elon Musk has donated heavily to the Trump administration, other Republican campaigns. And, the trade policy will likely benefit them as well if you get a Trump administration. Okay. But some of the big movers today, you had Tesla down over 3%, NIO down over 7%, Nvidia was up over 3%. What else? You had Palantir up 4%, and Vale down about 2.5%. So those are kind of the big movers. And really still top of mind is that trade around oil. Oil's been down on its luck. It hit around $65 a barrel twice, and now we bounced back into the low 70s on these geopolitical tensions. And to me, I think it's still underappreciated, acknowledged that this is something that could continue to escalate. And it does. Once again, it's bouncing on this, but there potentially could be a lot more to come. And could you see oil back in the 80s? A higher geopolitical premium here, I don't see why it can't happen, because I don't see anybody trying to de-escalate the situation. And so that ultimately could continue to throw more volatility into markets. I think that's one of the main reason why you're seeing down days recently. Nothing major. There's nothing really telling you that this is a huge problem. But it is sparking volatility. The VIX has gone from 15 to 20 now in just the past week or so. Gold prices have pulled back, or have consolidated, excuse me. But that's in the midst of a rising dollar. The dollar has rallied over the past 5 days as well in that kind of flight to safety type of trade. And so as long as that continues, and gold drops sideways, that remains relatively bullish for gold, because as soon as you get the dollar coming down a bit, I think gold will take off once again. And so you're definitely seeing a flight to safety here. Bitcoin, interesting enough, not getting that flight to safety bid, actually. So yeah, it was up a little bit today, but still is down a decent amount over the last, last few months. So I think Bitcoin continues to struggle in the midst of stronger liquidity situations. So clearly it's not a flight to safety type of asset, shall we say. And so that was the market for today.
Hi, Justin and Luke. Great show, first of all. I wanted you guys to look at a stock for me. It's a Lincoln Financial. The ticker is LNC. And just tell me your opinion. I would appreciate it. Thanks again for everything you guys do, and great show. Thank you.
All right, looking at Lincoln National, they provide life insurance, annuities, disability, and dental products for individuals and employers. And this has been in a downtrend. And that's my first worry is, why is the relative strength so bad? Now, the space has been hurt. Look at Humana and United Health, and all of these names have been down on their luck. And so there's some in sympathy move here, but in general, this moved down pretty big back from, beginning of 2022 down to the beginning of 2023. And that was a bad year for stocks in general, but this moved from 75 all the way down to about 22. That was a huge move. And it's moved back a little bit, but overall the technicals are pretty broken. You don't have much earnings momentum either. So I would pass on Lincoln. I think there's much better options out there. Let's go take a live call. We know we love those, from Soma in San Francisco, looking at Cisco. Soma, are you there?
Yeah, I'm here. Yeah.
Great. You're looking at Cisco. Do you own it or looking to buy it?
No. I own some of them.
Okay.
Whether to hold them or when to sell it or to have to buy more.
Okay. So Cisco, we know, a very large company. You're talking about a market cap of $209 billion, and a good profitability, good quality business overall, right? And if you look at its chart, it's in a recent uptrend. That's a positive. Now, I think the first question is, what do you like about the business? Why do you hold it?
No, actually, when I bought, it was around 65 or 62. Mm-hmm. So now it's down. So I'm just holding them.
Okay, but what is it you like about the business? Like, why did you buy it in the first place?
They were doing good business. I think they were selling a lot of new routers, new Silicon One chips, and not chips, but basically the routers.
Okay, yeah, and Cisco was doing well, especially during the pandemic. They earned a record high $3.89 in 2023. But so far last year and this year, earnings continue to ebb a little bit, although they are supposed to rebound next year. So I think that's why the stock has struggled a bit since late 2023. But it is still a good business, has a good balance sheet. It has free cash flow of about $10 billion on a enterprise value of $223 billion. That's a solid 4.5% or so free cash flow yield, pretty good. Dividend yield is at about 3%. What are they doing with the additional cash flow? Well, they are buying back shares. I like that. So return on equity is at 23%, which is a bit below its 5-year average, but historically, its return on equity has been high teens, low 20s, kind of where it's at now. So I think that's about in line with the longer term average. So I have no issue with it. And once again, the technicals are improving from the kind of malaise it was in for late 2023 into the first part of this year. So the technicals I like, the fundamentals in the business I like. So I would continue to hold it, to be honest with you. I think you just had bad timing when you got into it.
The newest InvestTalk Wealth webinar is happening online and free in just a few days. The InvestTalk Wealth webinar will focus on effective strategies for managing your 401k and enhancing your retirement savings. Go to investtalk.com and sign up for our upcoming Wealth webinar, October 8th. It's free to attend, but you must pre-register. And please tell your friends.
Now let's keep things moving and play another listener question from our anytime listener line at 888-99-CHART.
Hi, it's a great show, but I got a problem with your not recommending Nvidia. I've made $1 million on Nvidia already. According to the CFO, Jensen Huang, the demand is through the roof, and there's even some tension among his customers about getting the chips. And then they've got a new blockbuster chip coming out named Blackwell. So they're going to make a lot of money, and I think you're a little off on that one. I would like you to comment. I'm a little confused about if you get a dividend from a company, does it depend on the amount of money you've invested or the amount of shares you have? Because it seems like a stock like Oprah, which is low price, and you could get a ton of shares versus maybe a more expensive stock like UPS. It also has a good dividend, but for the money, it would seem like Oprah would be a much better buy if it depends on the shares. Okay, thank you.
Well, Nvidia, I don't say Nvidia is a bad company. It's just more of is the value, has the valuation, are all those optimistic forecasts kind of priced into the market, and I think in many ways it has, and we'll see. Obviously it can continue to go higher if those growth projections continue to stay relatively solid. But as I said earlier in the show, if the growth projections unwind and that optimism that you obviously have and many other investors have, if that just ebbs a little bit, then obviously the multiples will come down. And so, remember, the market is always pricing in the bullish and bearish outcomes for the actual underlying business. And the way investors make money is to actually take the other side of the bet that the market is priced in, right? And so if you're and you see this many times in the past where companies that have done great have a lot of optimism going forward, and they continue to do well. Cisco is always the good example. Is their business continue to do well, but it was priced so perfectly that the forward-looking returns were really bad, even though the business did well. So it's not that, just because you may not say that it's a good time to buy a company doesn't mean that the company is bad or their business won't do well in the future. It's just what is priced in versus the reality of the future. And so that's always what an investor is trying to figure out. Now, when you're talking your other comment about, I believe it was Opera versus UPS, what you're looking at, is always the dividend yield, right? The price per share or dividend per share divided by the underlying price. So for Opera, it's a $14 stock, but its last dividend round is only 41 cents. So you multiply that by 4, right? Quarterly, that's about $1.60. And that gives it a nice, let's see. Actually, no, it looks like they pay that twice a year. Let me see what Opera is doing. Yeah, it looks like they pay that twice a year. So that's about 80 cents on $14. And therefore, you're getting about 5%, 5.5%. UPS, the yield it's a higher stock price, $130 per share. But its quarterly dividend is $1.63. So you multiply that by 4 because it's quarterly, and you're getting, it's about $5.60 on $130 per share. That's about a 5% dividend yield. And so both have about a roughly, give or take, a 5% dividend yield. So it's not about what the share price is. And that's the number one lesson you have to learn is UPS at 130 can be a lot cheaper. I'm not saying it is because I have to look in the details, but it can be a lot cheaper than Opera at $14 per share. You never want to look at that. It's always in relation to earnings, dividend per share, the debt on its balance sheet, the sales per share, cash flow per share, profitability metrics like return on equity, return on assets, et cetera. So, you never look at that. You never look at, is it 130 or is it 14 or is it $2,000 per share? That's relatively irrelevant until you look at it in context to the underlying the underlying fundamentals. Okay. Now let's pivot over to a question submitted via the YouTube channel. And Jim Leahy says, do you think CSL is a good buy? CSL is the symbol. And this is Carlisle Group. And this is an industrial name. And what they do is they make, pull this up here, they manufacture thermoplastic roofing systems, off-highway braking systems, and friction products worldwide. It's a fairly big company here with a market cap of, pull this up here, $20 billion. So it's a borderline mid-large cap name, a little less than 1% dividend yield. Relative strength is nice at 90%. It is closing, they closed today right around its 52-week high. So that's a positive. And earnings are expected to accelerate into next year, up 32% in earnings this year and 13% next year. Those are the estimates. A good balance sheet, which I always like in this environment. You have only about $1 billion in net debt, return on equity 46%, return on invested capital 26%, free cash flow about $1 billion on a $21 billion market cap. It's about a 5% free cash flow yield. And it certainly has room to up that dividend. So I think that will happen as well. But they're taking a lot of that cash and they are buying back stock. So that in many ways is a more efficient way to return capital to shareholders. And I think they're doing that in spades. So I'm going to give Carlisle Group a thumbs up because of the quality balance sheet and quality business overall.
Hello, this is Daniel in Tennessee. I have a question for you about CVS. There was some news that came out within the last week or so about where they're considering splitting off Aetna, who they acquired in 2018. And I was researching it, and I thought I'd ask you for your advice. I saw when CVS acquired Aetna in 2018 that they paid around $70 billion for them. And I noticed that CVS is now, combined with Aetna, is only selling for a market cap of $80 billion. So would that make buying CVS now a good buy, considering if they do split up the two companies, you're basically getting Aetna, which was 6 years ago, or $70 billion, and CVS, which to me seems like it'd be worth way more than just another $10 billion for $80 billion combined. Hopefully that makes sense. Just kind of curious what your thoughts are, if that seems like a good buy, if they do move forward with splitting up the two companies. Thank you.
Well, I definitely understand your thought process there. However, 8 years is a good amount of time. And as we all know, prices of businesses go up and down. So, and we know oftentimes companies overpay for businesses. And what the market is telling you right now is that CVS drastically overpaid for Aetna, because otherwise its market cap wouldn't be where it's at. Because we know the rest of their business is certainly worth well more than $10 billion, right? The delta between that 80 that's currently trading at and that 70 billion that Aetna they bought Aetna at. And another important aspect here is the debt, right? Is that did they buy Aetna with just cash, or did they layer on debt? And it's not just the market cap, because the market cap is 80 billion, but the enterprise value is 129 billion. So that is debt plus the current market cap, okay? Net debt plus the current market cap. So there's that aspect as well. And that's why enterprise value is always a much better metric to look at than market cap, because it's about what would it take? That's enterprise value is basically saying, what would it take to own all the business plus wipe out all the creditors, pay back all the creditors so that whoever owns that business, there's nobody else standing in line to collect, interest payments or any part of the business that they now own. And so it's very important to consider that debt. And CVS has a good amount of debt, right? About $49 billion in net debt. And so that's part of the reason why they are looking to spin this off. I think they're looking to right size their balance sheet, probably spin off some of that debt with the breakup of these companies and try to split off into 2 or 3 different names, spread that debt across, and try to survive and really create a broader, better balance sheet amongst the 2 or 3 entities. And so there are many reasons for them to do this, but your thinking is, I think, overly simplistic and not incorporating that debt aspect. And so it wouldn't be a buy simply because of the breakup. Usually when you see these things happen, it's more of an act of desperation. They can't really find a way to solve the problems that they've gotten themselves into, and that's what CVS looks to be doing right now. So it's out of desperation, not strength. Now let's squeeze in one more question now at 888-99 chart.
This is Amir from Michigan. I have a question about Carvana. I know it grows rapidly during the past months. I just wanted to know your idea about this stock. I'm looking forward to your response. Thanks so much.
All right, Carvana, and this is an e-commerce platform for buying and selling cars. And this is a name that cratered in 2022. It was down significantly. Let me pull up a chart here. Go to a weekly chart so I can zoom all the way out. Yeah, it peaked out at over $375 per share and hit a low of, $1 or so. And now it's all the way back to $176 per share. So quite the round trip. And I wouldn't say round trip because it's still well below its all-time high. And frankly, it's getting into some major resistance here at around 190, major resistance at 234. So, could it have some more upside in the near term? I think possibly. But ultimately, this is a horrible business. It really is. Its return on equity remains negative. It's never really been positive. It has positive free cash flow. That's good, but they have a good amount of debt in their balance sheet. So I don't think it's really worth the value it's at now. As for momentum play, you could buy it, but not as an investment. It's just too poor of a business. Thanks for the call.
Hi there, Duncan from New York, calling about stock ticker Kinsale Capital, KNSL. I would like to put this in my growth portfolio. I follow, a couple of podcasts from a growth standpoint. I know this is an insurance play, so I just wanted to get your 2 thoughts about it. Thank you very much. Bye.
All right, looking at Kinsale Capital Group, and it is a mid-cap name, roughly $11 billion market cap, and it's certainly a grower. $1.24 in earnings back in 2017. And this year, earnings are supposed to be $15.20. So think about that. Just consistent 30, 40, 50% growth year after year. So that's what he's talking about. This is a serial growth company. And the chart says it. It's up and to the right. That's for sure. Now, recently, it's been a little choppier. It's hit a little bit of a peak in October of last year. And it's been kind of in this broad trading range between 540 and let's say 350 over the past 6 months since March. March was the all-time peak, 545. And so, its technicals are good, but, momentum certainly weakening. It's telling you that, is there some risk to the multiples that it's trading at? And if analysts are correct, this quarter, you might see that. Earnings are supposed to be up 9%, but that's well down from the 30% growth in the second quarter and 102% growth in the third quarter of last year. And then revenues are supposed to be down 5%. So that's obviously not good. Now, one quarter is only one quarter. It could certainly reaccelerate, and markets are expecting it to reaccelerate into next year. However, not the same level of growth. Earnings this year are supposed to be up 22% and 16% next year. And it had been growing, like I said, 30, 40, 50, 60% per year earnings growth. So, there's always a lot of large numbers here that they're contending with. So that's one issue. I don't mind it because I think I like the type of business that it's in. Obviously, the insurance business, they have a very good balance sheet, net debt on their balance sheet. They pay a little bit of dividend. They're very profitable. They're taking their $1 billion in free cash flow on a roughly $9.5 billion in enterprise value. That's a strong free cash flow yield. So I like that. So I like a lot about the business. It's just, you do have to worry that growth is slowing, and that could bring multiples down a bit because price of sales is at 7.8. We know anything, approaching 10 is usually pretty hefty. And that would be my biggest worry. So I'm okay with it, but it's certainly higher risk than it's been in the past because of that growth continuing to slow. Okay. Thanks for the call. Now let's touch a bit on recessions. And a lot of people think of recessions and they think of the most recent recessions. Now, the recession is defined by the National Bureau of Economic Research, and it's when a country's GDP contracts on a real basis for 2 consecutive quarters. And there are other aspects to it as well. And that's why usually the NBER is the one that says, okay, we're in a recession. But it's usually in hindsight. Okay. Now, clearly we're not in a recession now. GDP growth still is, 3%. Even if it's revised down, it's unlikely to go all the way to negative, right? And if you look at the previous recessions, one was very, very short. The 2021 was the shortest on record. It lasted 2 months, according to NBER. And that wasn't even 2 consecutive quarters. It was just 2 consecutive months. But it was so dramatic that they called it a recession. Now, the one before that was the financial crisis, 18 months from 08 to 09. And that was the longest post-World War II recession that we had. And both had severe shocks. And that's why most people think of those as recessions, and they were, but those aren't typical recessions. A more typical recession was actually 2001, where GDP fell in the first and third quarters, while unemployment rose from about 4.3 to 5.5. Now we're around 4.3 right now, and 5.5 was the lowest level coming out of a recession in over 50 years. So that is a more normal recession. Now, usually go a little bit higher than 5.5, but clearly the low 4s in unemployment isn't a recessionary environment or one that really would precipitate a huge drop in equities. And so that's what you have to understand as well. It's just a recession doesn't automatically mean a calamitous equity market. It can just mean a choppier, more volatile period, but doesn't necessarily mean a major drop in equities. Now, I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, Google Play. And be sure to rate and review on iTunes as well. And make sure to sign up for our wealth webinar coming up in 5 days by heading over to investtalk.com. Independent thinking, shared success. This is InvestTalk. Good night.